Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniela Chuan here, and today we are going to work on section 5-1, the advanced level. Problem number 1. You are given the following information for the biggest publicly traded auto manufacturers based on the IPO price. You own a private company, a motor manufacturer, which has revenues of 15 million and earnings of 1.5 million last year. You plan to have your private company go public. You will issue a total of 50,000 shares. Estimate the IPO price using the average of the given price to earning ratio. So here in this problem, we are given two different ratios. One is the price to earning, and one is the price to revenues. This number means, for example, for General Motors, the price to earning ratio is 22.7. That means, let's say, if the earning is $1, then the price should be 22.7. And similar for price to revenue ratio, let's say if the revenue is $1, then the price should be $1.42, and so on. So now you have 15 million revenues and 1.5 million earnings, and we have totally 50,000 shares. And the question asks for estimate the IPO price using the average of the given price to the earning ratio. So here, the average of the given price to earning ratio, we have to take the average of the first column. So we got 28.6, and this is the price over earnings, which means for $1 earnings, we have the price is 20.6, and this number 20.6 comes from the average of the first three numbers in the first column. See that? And now we got the price over earnings, and we got 1.5 million is the amount of earnings, so we can find the total price. We take 1.5 million times 20.6, we got $30,900,000. And this is the total price for 50,000 shares. So the IPO price is 30.9 million over 50,000, which is 618. That's problem 1. Now let's look at problem 2. Which of the following are corporate debt, which are secured debt, which are unsecured debt? 1. Notes. 2. Debentures. Mortgage bonds, asset-backed bonds. Here, all of these are corporate debt. And for secured debt, we got mortgage bonds and asset-backed bonds. And unsecured debt are notes and debentures. So, problem 3. You founded a firm with $15 million and received a total of 5,000 shares of stock 5 years ago. At the end of the first year, you sold an additional 2,000 shares to your daughter and 500 shares to your son for a total of 2,000. Currently, a venture capital firm who believes that your firm has high potential plans to invest $55,000 in your company. Determine the share price for this funding round if the post-money valuation for your firm is $120,000. So here we have the post-money valuation and the amount of money that we invest. So before we calculate the price of the share, we have to find the pre-money valuation by taking the post-money valuation, subtract the investment amount. So we take 120,000, subtract 55,000, and the pre-money valuation should be 65,000. Now the number of shares in total, we have 5,000 shares with 2,000 shares that we sold to the daughter and 500 shares to the son. So totally we have 7,500 shares in total. Now the total money, the pre-money valuation is 65,000, and there are 7,500 shares in total. So the share price for this funding round is 65,000 over 7,500, which is 8.67. Problem 4. You founded a firm with 12,000 and received a total of 4,000 shares of stock 5 years ago. At the end of the first year, you sold an additional 1,000 shares to your daughter and 1,500 shares to your son for a total of 200. Currently, a venture capital firm who believes that your firm has high potential plan to invest 85,000 in your company. Determine your percentage ownership after this funding round if the post-money valuation for your firm is $110,000. Solution. Similar. First, we have to find the pre-money valuation, which is 25,000. Then the number of shares in total is 6,500. So the price per share is 25,000 over 6,500, which is 3.85. So 3.85 is the price of one share. Now, in this funding route, you got 4,000 shares, and your daughter have 1,000 shares. Your son have 1,500 shares. So your ownership should be 3.85 times the number of your share, which is 4,000. Then take this product, divide by $110,000, and we got 0.14, which is 14%. So your percentage of ownership in this problem is 14%. Here 11,000 is the post-money valuation. So in order to find your percentage of ownership, we have to calculate the total money that you have by shares, then divided by the total post-money valuation. The last problem. A firm was founded with an initial investment of A firm was founded with an initial investment of $120,000 in 2016. You're given the following series of stock issuance. In August 2018, the firm faces financial difficulty and is bought by the state government for $1.5 million. A series of shareholders has seniority over the earlier ones. Jane holds 100 preferred shares of Series B. Determine the total amount she will receive. Here on the table we have the number of shares issued, the price per share, and the liquidation preferences corresponding to these four series. And the question focuses on Series B, so we have to focus on the second line. And the total amount here should be number of shares times the price per share times liquidation. And we focus on Series B, so we take the number of shares, which is 1,000, times with the price per share 240, and times the liquidation 1.0. So the total amount that she will receive is 240,000. Alright, so that's it for today. Thanks so much for watching. If you like this video, please give me a like, a share, or subscribe. See you on the next video. Bye bye.